Dividend investing is dying. And if you're still holding stocks like AT&T, 3M, Walgreens Boots, or even popular dividend ETFs like SCHD or JEPI, then you need to hear this. Because over the past couple of years, there's been a huge shift in the income investing environment. Dividend aristocrats and dividend kings that were traditionally safe havens for income investors have been slashing their payouts. Some have cut their dividend completely, and yields as a whole have been going down for these larger cap stocks. So income investors are now forced to make a choice: accept lower returns or find a better way. And that better way is what I'm going to talk about in this video. So if you don't know who I am, my name is El-Gorr. I run a company called Freeman Publications, and what we do is we help individual self-managed investors get better results from their portfolio. And one of the ways we do that is we help people generate reliable monthly income without solely relying on dividend. And you can make anywhere from 1,000, 3,000, or even more each and every month using this strategy. So stick around, because what I'm going to talk about could completely change how you think about income-focused investing. And just to be clear, this has nothing to do with timing the market or any sort of wild speculative trade. In fact, what I'm going to show you today is more conservative than just buying and holding dividend stocks. But before we get into that part, we should probably look at the state of the current dividend investing market. And to do that, let's get into the handy dandy PowerPoint presentation. Let's get into it, shall we? Let's look at why dividend investing is dying. And this is very timely, as literally 2 hours before I went to film this video, Walgreens actually suspended their dividend completely for this quarter. So a bit of context for why I'm making this. Now, dividends are, I believe, the only truly passive income that exists. You've got a lot of things that are semi-passive, one of which I'm going to talk about in this video, but dividends, they are truly passive. But the issue is, people get sold on this sort of passive income lifestyle, the FIRE movement, and, you seem get people thinking if they just put $100 a week into these dividend-paying stocks, they're going to be able to retire in their 30s, 40s because of that dividend snowball thing, where the dividends will add up, they'll add up, they add up, and eventually you'll be able to just live off all of them. But realistically, you're going to need a bare minimum of $1 million invested to do that. And I'm going to explain why even that's a bit flawed. Because if you're trying to get here on dividend stocks alone as well, you're going to be slowing down the growth of your portfolio. And either you're delaying the day where you're going to reach that number, or you're never going to reach it at all. And even if you do reach it, it might not be the life you dreamed of. Because actually, people think that $1 million is not enough anymore. This is from Northwestern Mutual 2024 numbers. Americans think they need $1.46 million to retire. Now that number is actually up from 951,000 in 2020. So in just 4 years, from 2020 to 2024, that number's gone up by almost 50%. Tell you what hasn't gone up by 50%, dividend payouts. But the average adult in the US isn't anywhere close to that. In fact, the average adult has $88,400 in retirement savings. That's the median balance for all you statistics people out there. 53% of adults in the US now believe they're behind on their retirement savings. And let's be honest, if you've got $88,000 in a retirement account, dividends aren't making a dent. You might be lucky to make $500 or $600 a month with that amount. And here's the real issue with dividend stocks today, because the SPY dividends are at a 25-year low. They're at the lowest they've been since 2000 in the midst of the dot-com boom. Yield is currently hovering around 1%. And a big reason for that is we've really shifted from an environment where the biggest companies in the index were these large conglomerates. I'm talking ExxonMobil, General Electric. And now for the past 8, 9, 10 years, it's just been a tech bonanza at the top, which has been absolutely fantastic for capital gains. I hold Meta, I hold Google, I hold Microsoft in my portfolio. It's been phenomenal. But if you're looking for income, it ain't happening with the S&P 500. And with these large tech companies needing huge amounts of capex for their AI expansions,
you ain't going to get large dividends from any of them anytime soon. But the common retort to this is, well, I don't own the S&P 500. I only buy these dividend aristocrat stocks, and these companies that have been increasing their dividends for 10, 25, the dividend kings, 50 years. These may be historically great companies, but their future may not be as rosy. Because just in the past 3 years alone, we've had 3M cut their dividend in half. Walgreens Boots had a 47% cut, followed today, January 31st, 2025, with a dividend suspension. Intel cut their dividends by 65%. Leggett & Platt cut their dividends by 89%. AT&T, long-time big dividend payer, they spun off Warner Media and cut their dividend. And VF Corporation as well with a 30% dividend cut. That is literally just in the past 3 years. So many of these names that were stalwarts and mainstays of good dividend portfolios are no longer worth owning. And you see here, Walgreens Boots, beginning of 2024, cut the dividend by 48%. And then literally today, January 31st, 2025, they've stopped the dividend entirely because they need the cash. And this is the case for many of these historically great companies. But the problem is, you can't live off their historical performance. You can only live off what they're doing in the future. And when it comes to their dividends, those are the things that are being sacrificed in order to maintain the health of the company. Some of you might be saying, well, what about these high yield stocks? And this is a very common mistake in income focused investing. You go to a stock screener, you filter stocks that only pay 8%, 10%, 12% dividend yield. And to be honest, it's mainly garbage. Companies that pay yields like that, most of the time, it's very risky things, like mortgage REITs tend to be up there, BDCs, business development corporations, tend to be up there. These tend to be very, very cyclical stocks, and a lot of the time it's just not worth holding. This is just one of them here, Annaly Capital Management. You look at this, yes, the dividend's 13%. You've lost 50% of your principal over the past 5 years. They may have high payouts, but it comes with ever declining stock prices. And to be honest, it's one of the riskiest options you can do, but it's masquerading as one of the safest because of that high yield number. And you can't buy a company just based on this yield percentage number alone. Then we go to the dividend ETFs that are very popular. And just because something has dividend in the name, it doesn't necessarily make it a great income generator. These are the big three, and by the big three, I mean the three largest. You've got SCHD, VIG, and VYM. You're getting an average yield of 2.8% between the three of them. They might be fine if you're looking for capital gains as well, but if you're purely looking for income, you're getting $28,000 on $1 million portfolio. It's hardly retirement money. $500,000 in those three split equally, you're barely getting $1,000 a month. And that's not really going to make a dent for a lot of people. And so there's got to be another way, and I will come to that in a little bit, because there's another worrying trend that's popped up, and this is these high yield income focused ETFs, these option strategy ETFs. Yield Max is one of the more popular companies. I've got TSLY on the left here, and I've got just Tesla, the actual stock, on the right. So these ETFs, they make money by selling covered call options on the particular stocks or indexes. Once again, you are directly sacrificing capital gains for income if this is the case. Tesla doubled in 2024. Yield Max ETF, exactly, it's the same thing as Tesla stock. The stock doubled, the ETF was down 26%. Now, a lot of that is by design, and I'm going to come on to that in a little bit, but just bear with me for a second. Same thing with NVIDIA. The Yield Max NVIDIA ETF declined. NVIDIA, the stock, was up 136%. Now, why is this? How can that be possible? Well, it's to do with how these ETFs are actually designed. Even with dividend payouts, if you factor in total return, you are not getting the same results as if you would have just bought and held the stock. We've got Tesla up 99.85% in 12 months. The ETF, TSLY, even with dividend payouts, it's up 50%. So you're losing out big time. Same thing with the bigger index ones. QQQ was up 25% last year. That's the NASDAQ 100. QQQY, which is an options-focused ETF, which sells covered calls on the QQQ, 8%. It's all to do with how these are designed, because you are trading capital appreciation for dividends, because they are literally returning capital to you, because that is how they are designed. QQQY, the shares are down 43% over the past year. And you might be thinking, well, it doesn't matter because I'm getting the income. But if you ever sell your shares, you're barely breaking even with these payouts. And that is before we even take the fees into account, because most of these have a 1% fee. So that's another percentage point that you've lost each year. The other part of this that I don't think people really understand is most of these, especially these option ETFs, have only been around for a year, some of them 6 months. None of these have been battle tested in a bear market. So I have no idea how they're going to perform. And that is a really scary proposition, especially if you've got a big chunk of your portfolio in these newer option-focused ETFs. You've also got the QYLD, the XYLD, the RYLD. These sell covered calls on the indexes. You've got JEPI and JEPQ, which is a combination of covered calls and then long stock positions as well. Now, this I will say is probably the best of the various income-focused ETF options. You're going to get a fairly consistent 5 to 7% a year. But even so, for a lot of people, that's not going to be enough if they don't have a portfolio that's high 6 or in the 7 figures. So even though that's the best of a bad bunch, I still wouldn't personally own it. And these all became popular in 2022 when the market was tanking and they were paying 10% plus yields on paper. But once again, you do have a similar problem as before. You are trading capital gains directly for income. Look at this. QYLD, the option ETF, QQQ, this is the 5-year time period, because QYLD is one of the few ones that has been around for 5 years and did go through 2022. Yes, the volatility is less in the bad years, but you're not getting the income in the good years to make up for it. If you just held the NASDAQ, you would have got 3 times your money. So once again, it's not ideal, even if your main focus is income. 7% a year on $500,000 is $35,000. For some of you, you may be able to live off that. For a lot of people, they won't. And like I said at the beginning of the video, the simple truth is you need $1 million portfolio to live a comfortable middle-class lifestyle if you're just relying on dividend stocks. And that's especially if you're in the early years of retirement or just coming up to retirement and thinking about it. If you've still got a family to support, and God forbid, if you're what I call part of the sandwich generation, where you've still got kids to support, but you've also got aging parents to support, then it's going to be really, really tough if you're just relying on these classic dividend-paying stalwart companies that really just are not delivering on their promise anymore. There's got to be a solution though, and our solution here, the way I see it, needs to be a vehicle for 12 to 20% gains without touching your principal, because as I've explained in many other videos, just getting to a big number and then withdrawing the principal doesn't solve the problem either. We need something relatively low risk where you can avoid massive drawdowns, and you also want something tax efficient. So if you can have something where you can do it in like a Roth IRA, for example, and you can have tax-free withdrawals while you're in retirement, that would be even better. And I think I found it. So it's called the wheel strategy, and it's where you systematically sell options, both put options and covered call options, on stocks you would like to own. Now, before I walk through what it actually looks like, I'm going to address some common sort of retorts to this. I say options and immediately people's brains start spinning, because options is a dirty word in this industry, especially when we're talking about safe, conservative strategies. Most people think options is pure gambling, and for a lot of the time they are correct. But the way I see it is options is a tool like anything else. You can use them for gambling. For example, if you're just buying far out of the money call options because you're hoping a stock's going to go up, then yes, that is gambling. You can use them for hedging. If you're buying long dated puts on an index, for example, to hedge the growth of your portfolio, that would be a very smart move if you have a lot of capital protect. Or you can use the method that I like, the wheel, to steadily generate income. And Warren Buffett, for example, he's used similar strategies to generate cash for Berkshire Hathaway at times. Now, this is from their 2008 letter to shareholders. See here, they were selling put options on indexes. So you've got the S&P 500, the FTSE in the UK, the Stocks 50 in Europe, and then the Nikkei in Japan as well. So they sold put options in 2008. They were long dated ones. They got, there's my dog. I'm going to keep that in. They were long dated options, and they received premiums of $4.9 billion that they invested. And I'm why is he outside? What are you doing, Jasper? Hang on. Let me go attend to him. The door blew shut. That's what happened. You idiot. Right, we're back after that brief interlude. So, Warren Buffett and Berkshire Hathaway received $4.9 billion from selling their put options, money they then invested. And that's one of the huge advantages of selling options, is you get paid the cash up front, as opposed to a dividend where you put the money in and then have to wait for the dividend payout. And so this is a big reason why I love the wheel, because you get consistent, reliable income. You can be as conservative as you want, because you get total selection over the stocks you use. You can make 9-10% a year if you just use the large indexes like the SPY or the QQQ. If you go to sort of individual stocks, blue chip dividend stocks, a lot of these names that we've discussed in this video, or sort of sector ETFs, then you're looking at 12 to 20% a year. You can do 25% plus with mid and large cap individual stocks. And me personally, I did 36.5% in 2024, mostly trading mid and large cap stocks. And the cool thing is, only takes 4 or 5 hours a week, because I don't really want to sit around staring at a screen all day. Don't know about you, but I'm not a big fan of that. Don't want to do day trading or anything like that. And the other thing is, you can use it to lower your cost basis on stocks that you already own or potentially would like to own. So let's do a case study here. And I've used Pfizer for this because this is quite a popular dividend paying stock right now. Now, it currently pays a dividend of $1.72 per share, roughly a 6.4% yield when I'm filming this video. And I can buy 1,000 shares of Pfizer today for about $26,800. Now, unfortunately, from a dividend perspective, I've actually missed the cutoff date to get the March payout. So the next payout date that I am eligible for, if I bought the stock today, would be in June. And for my 1,000 shares, I'd receive $430, because the quarterly payout for Pfizer is about 43 cents per share. So that's if I just buy the stock and wait for the dividend payout. But for the same money, $26,800, I can sell 10 options contracts, because one options contract is 100 shares of the stock. So 10 options contracts is 1,000 shares. Now, if I sell those contracts just at the same level the stock's currently trading at, so for those who are more experienced, I can do an at-the-money put option, I'd get $420 in my account for 10 contracts today. That's for a 28-day trade. And the cool thing is, when you sell options, you get paid up front. Now, a lot of you might be thinking, that's the same amount. You get $430 for the dividend, $420 for the option. So how is this any better? Well, the difference is the option trade only lasted 28 days. So I can just do it every month. And so if we look at this, my income from holding 1,000 shares of Pfizer, if I just bought it today and held it, I'd get nothing in February, nothing in March because I missed the payout date, nothing in April, nothing in May, and then in the June dividend payout, I get $420. On the option side of things, I would get $430 every single month if I just did the same trade 5 months in a row. That's $2,150. That's 5 times the amount without using more capital, without doing a different stock. I get 5 times the amount doing this versus just buying and holding it, waiting for the dividends. Let's do another example. Let's do an ETF. So for example, SCHD, which is a very, very popular income-focused ETF. Now, it pays an annual dividend of 99 cents per share, roughly a 3.5% yield as of today. And I can buy 1,000 shares for roughly $28,000. It's trading around $28 level. The next payout date for SCHD is in March, so I can actually take advantage of that. And I'll receive roughly $210 for my 1,000 shares. Now, with SCHD, the payouts aren't the same every quarter. They tend to be staggered towards the end of the year. So March is the lowest payout usually. And then each payout, June, September, December, gets a little bit larger. So March is about 21 cents. I've been generous here. I've given you 21 cents. Once again, with the wheel, same money, $28,000, I can sell 10 options contracts of SCHD. This is only a 21-day trade this time. I get $300 in my account. Once again, I'm getting that today because when you sell an option, you get paid up front. If you're asking where's this money coming from, $300 of credit, because when you sell an option, the option buyer is paying you. That's the big difference. When you buy an option contract, you got to pay. When you're selling an option contract, you get paid. Once again, same amount, but hey, it's only a 28-day trade, or in this case, a 21-day trade. I can just rinse and repeat it every month. So 1,000 shares buying and holding. I get $210 in March, and the June payout's a little bit larger, about 24 cents a share. So I'm getting $240 in June, $450. Same deal with selling the options contracts. I get about $300 a month. So this time it's about 3 times larger than just buying and holding the stock and waiting for the dividend. You can also use this approach to actually create your own dividends. This is a really cool idea. I call it CYOD, create your own dividends. Now, I love CrowdStrike, great company, great stock. It's one of my larger positions, but it doesn't pay a dividend. And if you want to earn income, you can create your own by selling an option on the stock. So for example, one options contract of CrowdStrike expiring in, it says 30 days there, it's actually 28 days, that will pay you $1,700. Not bad at all for a 28-day trade. Now, CrowdStrike's quite an expensive stock. It's $400 a share. And you might be thinking, well, I haven't got $40,000. Well, you can always do a cheaper stock. That's fine. Stock like SoFi, for example, that's a $16 stock. So you only need $1,600 because you need enough to own 100 shares of the stock. So one options contract expiring in 28 days' time, that'll pay you $78. And you ain't getting $78 paid into your account today with any dividend stock if you just buy and hold it. Just not happening. And so this is a really, really powerful strategy because it allows you to make a lot more income from the same amount of capital. And so the way I look at it, there's no additional risks. Of course, there's risks in all investing, but there's no additional risks versus just buying and holding a dividend paying stock because your downside exposure is still the same. If the price of the stock goes down, if you're buying and holding it, you still hold it. With an options contract, you get assigned the shares, which means you have to buy them, but you can sell covered call options and make more income, or you can just sell the stock and get out. But your exposure is the same whether you buy and hold them or sell options. And your capital upside with this strategy is capped by design. But if you're buying higher yield dividend stocks for the capital upside, well, that doesn't make any sense. So I don't understand why you would do that. So if we're purely focused on income and dividend stocks, then this is simply the superior strategy. And this isn't just theory either. This works very well in practice. I do it in my own account all the time. These are a bunch of people from our community. So Anthony did 56% ROI last year using this. This is Edinho. His pension plan gave him 4.5%, which is not great. He did 21% using this strategy. And then Nick, he scaled his account from making about $350 a month to over $3,000 a month in just 1 year. And the other cool thing about this is you really can do it from anywhere in the world, anywhere you've got an internet connection. You've got Janice here, been on vacation for 11 days. The option income that she earned paid for the whole trip. That's insane. That's phenomenal. Wen was on a cruise and he'd earned $1,000 in 12 days to begin the year. So that pays for a lot of the cruise. And my personal favorite, Stephen here, he was getting profitable trades while at Everest Base Camp. What is that? 15, 16,000 feet in the air? I mean, there's no cooler place that I've heard of people getting profitable trades from. And even myself, this is the contrast in my life. So I've had this trading while on a plane, going from London to Singapore. That was a lot of fun. And then I also had some profitable trades while I was waiting for my daughter to be born. And I should state, we weren't in active labor at this time. I was being very good. But hey, when the notification comes through that I've hit my profit levels and I've hit my profit targets, I'm going to take it. So yeah, from 30,000 feet in the air and also from the labor ward. So anywhere you've got an internet connection, it works. And whether you like dividend stocks, growth stocks, ETFs, the choice is yours. This is just a normal day within our community. We got Taiwan Semiconductor, Marvell, Hims and Hers, GDX, the Gold Miners ETF, PDD, Walgreens Boots, Chewy, JD.com, Lemonade, Instacart, Sea Limited. No matter what kinds of stocks you like, you can use them for this strategy. And if you're wondering, what does it take to get started? Well, what I'd say is if you've got $5,000 in cash, then you can probably start making a few $100 a month using the wheel strategy. And the cool thing is it's a defined risk strategy. So you only need the very, very basic level of options approval in your account. And you can do it in an IRA account. You can do it in a Roth. You can do it in a solo 401k or a self-directed one. And even with a modest sized account, you can make $2-3 a month consistently. And once your account gets up to sort of that 400-500k level, you can cover all your expenses just with the income you get from doing the wheel. And that simply is not happening if you're just buying these dividend aristocrat stocks. It's not. And I should also be honest with you about what this isn't as well, because it's only fair that I give you both sides to it. So it's definitely not get rich quick. You're not going to retire tomorrow or start making 6k a day unless you have a massive account. But what I will say is, if you're sitting here thinking about you're going to retire in 20 years' time, then that timeline can be condensed to say 12 to 15 years. Might not sound like a lot on paper, but what's 5 years of your life worth? That's a massive improvement. And it's also not completely passive. It's not completely hands-off, but it does only take 4 or 5 hours per week. It's also not immune to market fluctuations, and it simply does not work as well in a bear market. Now, in 2022, I didn't do 36.5%. In fact, I did 8% in 2022. But I'll take that in a year when the SPY was down 18%. And I've actually got another video coming up where I walk through exactly what I did in 2022 specifically to trade this in a bear market. So if you enjoyed this video and maybe you want to learn more about how this works, book on Amazon that I wrote. If you don't know that I write books, come on, get them on Amazon. They're fantastic. It's got 582 reviews, 4.5 out of 5. That's not too bad. Grab a copy of that. There's another video, which is a full walkthrough of the strategy. Literally, it's an hour long, me doing everything. You see me finding the stocks to use. You see me entering the trade. You see me talking about setting up take profit targets. Everything. Nothing's held back in that video. So that video is going to come up now in the bottom left or right corner of the screen. Yeah, take a look, because like I said, I hold nothing back and I walk through absolutely everything. So if you enjoyed this video, give it a thumbs up, leave a comment below telling me how wonderful I am, and I will see you in the next one.